Welcome everybody to the Mid-Michigan Roundtable, the March 2014 edition. I'm joined this evening by my good friend Cy Lynch from Atlanta and Mark Robertson from just down the road in Rochester Hills, Michigan. I'm sitting up north of Flint, Michigan, between Flint and Frankenmuth, and we're still getting snow. Snow is still coming down all day long today. Only measured about an inch, but we still got enough to measure, and it's spring, so I'm done with it.
Yeah, it's over, and Hugh McManus won't be able to join us tonight because he's in the air somewhere going right over the top of us on his way back to New York. So unfortunately, we won't have Hugh tonight, but he did pass on.
So take it away, Mark. Okay.
All right, let's go ahead and jump right into it then. And again, welcome everybody, especially if you're a newcomer to this. Extra big welcome hug. I would like to spend a little bit of time, and it'll be completely unrehearsed, with the Knights of the Round Table tonight, talking about, there's a lot of people writing things that say the market is extremely overvalued and topping out. And again, I just think we want to take a few moments and share our thoughts on what does that mean to the three of us. We know what it means to Hugh. Hugh likes to buy deeply discounted, high-quality opportunities, and he's been having trouble finding those. So that's what happens. I do like the notion of dragons, Darby dragons. I heard a great presentation by David Gardner of the Motley Fool a few years ago, where he talked about the edge of the medieval maps before people were convinced that the world was not flat. And basically any uncharted territories that had yet to be explored had dragons along the edge of the map. So kind of approach the potential market in under those considerations, and just kind of share some thoughts on it. And we'll have our customary stock picks for the evening. But again, welcome everybody. Again, if you have questions about these, or you want to be placed on a mailing list for future sessions, or you have friends that would like to be included, you can write to Ken's wife Natalie at that nkabula1@comcast.net. And also, if you have any questions, you can write to me, Mark R. at manifestinvesting.com. So let's go ahead and take care of the lawyers. Again, as always, no investment recommendation is intended. This is all about education, the demonstration of a philosophy and a process that many of us in this long-term investing community have used for decades. And everything is for illustration. We'll talk about real companies in real time, but it is in that spirit. That's the spirit it's intended. Do your own homework, please. And again, no investment recommendation is intended. Here's our general agenda for the meetings. We'll just talk a little bit about our results. What does our report card or scorecard look like on our scoreboard? And we'll check in and see if any of the companies that we have featured. We've been doing this now nearly 4 years, and perhaps some of the selections are worthy of being challenged or a quick audit. The three stocks are shown there that we'll be presenting: RAVN Industries, ticker symbol RAVN, eBay, and Body Central, BODY. And then we'll give you guys a chance to vote for any one of the three. And Ken, did you put in none of the above for this month?
I certainly did. Just
in case anybody gets, kind of cantankerous on us and can't find anything that they like. All right, just a quick summary of what we're doing here. We've been, like I say, we've been doing this almost 4 years. We had our fourth annual awards ceremony last month. Pretty wide berth of little golden statuettes handed out to almost everybody. I had to sneak one in to get one myself, but we do take this kind of seriously. We want to identify decent investment opportunities. For the most part, they're going to be core, blue chip, stalwart type opportunities, but we do permit every once in a while somebody to get a little frisky, and that's what one of mine will be tonight. We do want the collection of stocks over, the investing ideas over time to outperform the Wilshire 5000 by that long term. And again, this is part of the investment club philosophy, aiming for a relative return that's 5 percentage points or 500 basis points better than the general stock market. And it's an extremely ambitious goal, but many of us in the community have achieved that either with club or individual portfolios. We also like to see our our selections outperform the general stock market basically 3 out of 5 times, or maybe a little bit stronger than that. And that's what I mean by this accuracy goal down here. We'd like to see, you know, a minimum of about 60% over the long term. Okay. Well, very quickly, so we can get to our stock presentations, how we doing? And you can see a pretty decent trend, especially over the last couple of years as we approach that 4th anniversary. The results have been fairly strong. We do kind of sag back every once in a while, but that's definitely the direction that we want to be going in. We have a return right now. It's a couple percentage points better than the market. Again, that's since inception. Since inception. The numbers that you see posted there. And again, we want to get up here to this long-term objective of at least 5% overall, and we have every reason to believe that over the long term we may be able to do that. Anywhere in here, though, would be quite good. So we'd take anything we can get in there over the long term, but we do want to aim as our objective for that 5%. You can see we're not quite at the 60%. We've sagged back a little bit on the outperformance accuracy, but still, that's not bad. And that might not seem like a really good number, but our research basically says that the average investor, and that's not any of you, but the average investor achieves about a 30 to 40% outperformance accuracy. And again, that ranges from chasing hot stock tips to just throwing darts, but their outperformance accuracy is generally in that 30 to 40% range. So anytime you get up into 60, 70%, you're doing pretty well, especially when it's in combination with these type of numbers up here. Go ahead, Si.
I was going to say, Mark, just a quick comment on that. Certainly 60 to 70% is a great goal, and it's an achievable goal, and we should shoot for it. But one thing to remember, and I don't say this flippantly, stocks can only go down to 0. You can only lose everything. On the other hand, the top side is unlimited. Therefore, you know, as I have observed a fair number of these tracking portfolios, some of the ones with Manifest, the Round Table, as well as the one that I have of the growth stock column in Better Investing, sometimes have been running around 50%, but still a very solid relative return because you've had some good high winners in that portfolio. So all I'm really saying there is don't take seriously the fact, or don't take less than seriously the fact that your downside is, you have limits on the downside. You don't on the upside.
Yeah, good point. All right, so let's go ahead and talk about the portfolio itself. Here is the tracking portfolio that Si just referred to. And again, this is the largest or most frequently selected positions in the portfolio, ranging from Cognizant Technology at the top down to Vera Bradley. How do you like that one, Ken? Vera's actually back on the board. You can basically see, again, just everybody knows this, it's been here before, but anytime you have a repeat selection like Cognizant, what we do every month, if somebody selects one of these companies, even including the audience, we basically invest $1,000 into that company. So Cognizant Technology has had $9,000 invested into it. It's now up to $12,000, and that's actually off a couple $1,000s from where it was a little while back. Again, Qualcomm has been selected 7 times, so $7,000 has become $8,500. And then down here at the bottom, Vera Bradley, now coming in at about $3,000, has actually been selected 3 times, so it's kind of back to the cost basis, or the average cost basis, if you want to think of it that way, of the 3-time selections. But again, from top to bottom, some pretty good stocks, community favorites. You know, you got BioReference Labs in there. Some of these have done spectacularly well over time. And again, the entire portfolio is available as a public dashboard on the home page, so you can actually take a look at it that way. Let's take a look at the other end of the portfolio. And by other end, I mean taking a look at the companies that have the lowest returns. We tend to think of this as almost a challenge process. And we're taking a look at the companies at the bottom end of the portfolio that have the lowest return forecasts or projected annual returns. And actually, all of those are pretty good. The overall portfolio is pretty good. unless you guys see something that you insist on beating up, I don't see a whole lot of reason for activity tonight.
I really like the target numbers at the bottom, Mark. The only number that I think might be boosted a little bit, and we're not going to boost that number very much by removing or adding one stock, but I'd love to see our growth number up around 11.5%. So maybe we need to look at a few companies, more than just a few, that are growing a little bit more quickly than some of them we've chosen.
Yeah, and I think only eBay fits that criteria tonight. But again, we've got 4 years worth of selections. It's something that we'd have to do with fairly consistent over time. One of the things we did want to point out, 3D Systems is certainly a non-core type holding. It's quite speculative. This is a picture from a couple months ago when we basically encouraged everybody to understand that these stocks can be overvalued for quite a long time. And what I did want to show the audience tonight was, here's a 5-year look at 3D up to date through last night. And you can see, it's had a little bit of a swoon here lately. And trust me, the day traders and the people who trade stocks are going crazy about this. Most of us just see that as, perhaps the advent of an opportunity. This is a company that, again, has been oversold or potentially oversold for a long time. The blue line is really looking nice. That's a moving average of the stock price, measured in months and years, not in minutes or days or weeks or anything like that. Very long-term chart, and again, it's a non-core holding. I'd only become seriously concerned about it even if I were thinking of trading it. If it lost this momentum here, the price momentum, it's up 80% over the last year, and if this deteriorated a little bit more here, the relative strength index. So again, this is just one. It doesn't matter. It's a non-core holding, and it's still pretty good here.
Well, and Mark, I want to reiterate, since it's my choice that 3D was in there in the first place, I want to reiterate that 3D is the kind of stock that I like to occasionally place in one of my portfolios and then literally ignore for a long period of time. I wish that I wouldn't be reminded of it on a weekly basis or on a daily basis, but I would love not to look at 3D for 3 or 4 or 5 years. And if it disappeared in that time period, so be it. But I think it's the kind of company, the kind of technology, the kind of business that has the potential to really change the world, and therefore make a huge amount of money or go belly up in a small amount of time, one or the other.
Yeah, and as a small starting position in your portfolio. So,
and actually, that's has 3D only been picked once, or has that been?
It's actually got it twice. Well,
I think on the night that I proposed it, the audience picked it as well, Mark.
That's correct. So it's chugging along. It's actually gained 20%.
Yep.
Since then. I'm surprised that's not a little bit higher, but keep in mind it was $97? Yeah, $97 back earlier this year. So it's been cut in half. So again, we look at that and just shrug and don't panic. Other people who are not long-term investors would be probably in a full panic mode.
Well, and I'm also not panicking, Mark, because it doesn't represent 40% of my holdings either.
Sure.
So.
Okay. All right, well, then let's go into something that's a little less 3D, although I think it's a fascinating company. It's one that I've watched Ken talk about for now. We found an article from 2006 a few minutes ago. So RAVN Industries, pretty interesting company, and I think will probably be relatively new to some of the people in the crowd. Take it away, Ken.
Okay, I'm going to move to my screen, Mark, if we can make me the presenter.
I'll take care of that if you want, so you can get ready.
Are you going to do that? Oh, there we go. I have it.
You got it?
Yep. And we're going to take a look at just a few slides from a very, very well done presentation on the RAVN Industries website. These are just a few selected slides from the presentation. If you're interested in this company, I would urge you to go to their website and take a real close look at the entire presentation. So who basically is RAVN Industries? I've heard RAVN called the General Electric for the small stock set. It's a much, much smaller company than I'm normally used to thinking of as diversified, and yet it operates in a large number of different industries and three basic divisions. You can see that the revenue is fairly evenly split between those three divisions. We have Applied Technology, Aerostar, and Engineered Films. And if we take just a real quick look at the three divisions themselves, Applied Technology deals with agriculture for the most part, helps farmers figure out how to spray their fields, where to spray their fields, when to spray their fields, how much to put onto the field. It deals in GPS guidance so that when we put the materials into a vehicle and start moving through the fields, we cover the field, but we don't over-cover the field. That means that farming is becoming increasingly computerized as we try to maintain a balance between fertilizer and pesticide and all the other things we use to improve yields. The customers for these products are 55% original equipment manufacturers, that's OEM, original equipment manufacturers, and about 45% sold directly in the aftermarket, and the products go to 50 different countries throughout the world. Second division is the Aerostar division, and this division originally grew out of a division that used to make float balloons. They found that if they were making a balloon to run down the street in the Macy's Christmas parade, that they could also make things that would float high up into the air. And today, the Aerostar division is doing all kinds of products that are helping us with weather detection and research and things about protecting the country and looking for various types of measurements. The customers include the United States and foreign governments. Notice Google on that list of customers, and also RAVN is one of their biggest customers. Google is especially interesting for this company because RAVN is providing the balloons for Google's initiative called Project Loon. And Google's making an attempt to use these large balloons, floating them well above the surface of the earth up into the atmosphere. And their goal is to provide broadband wireless to people that otherwise couldn't receive broadband because of where they live and how isolated they might be. There's also a huge potential to improve medical care and to enrich agriculture if we can get this network of broadband wireless up and connecting parts of the country and parts of the world that right now just cannot be connected. Mark, did you have a question?
Well, I'm just sitting here, Ken, a little worried. You know, we're kind of close to April 1st. Are we sure we're okay here?
I'm sure we're okay, Mark. This is a real thing.
Okay, just checking, man. Just checking.
That last division that RAVN is really involved in is called Engineered Films, and RAVN does a lot to create and market different kinds of films, sheeting, to line a pond, for example, or to provide barriers between different gases, or to cover different types of agriculture. They might have different films to cover crops, for example, and protect against sun or protect against frost or various things like that. They also do a lot with geomembranes, and that's a big deal in a lot of the oil and gas drilling industry that we're talking about. And their customers include installers and, of course, distributors. So RAVN is those three divisions, and let's take a real quick look, if we can, at a current stock selection guide. RAVN is a classic cyclical company. It's an industrial company, and I was telling Mark before we began the session this evening that I'm finding lots of opportunities recently in the industrial sector. The sector has not been a particularly high-performing sector in the last 3 or 4 years, but I'm finding opportunity. I look at the SSG of RAVN, I look at the earnings line, for example, and I see the cyclical nature of the stock, and I'm asking myself if RAVN might not be at the bottom of a trough as a highly cyclical company. I've been taught that when I'm looking at highly cyclical companies, I should watch earnings per share values, and I see earnings going up and going up and going up from 2009 to 2012, and then hitting this dip in 2013. But even though the earnings have hit a dip, if you'll notice, the PE values have actually gone up rather than moving in the direction that we would expect for a high-quality growth company. It's true that when you're looking at cyclical companies, the best buying opportunity might be when PE ratios are at their high points rather than at their low points. Now, that's kind of counterintuitive, but it goes with this whole quality issue that people are less likely to sell off a high-quality cyclical. They'll hold on to it even when the earnings move down, forcing the PE value to go up. People will hold on to that stock, and then as the company moves out of the bottom of the trough, they'll be rewarded with earnings that will increase significantly on a nice trend for 3, 4, 5 years or so. I need to adjust my SSG here for the most recent 4 quarters and adjust this low price right here. I'm getting a fairly decent upside-downside ratio, around 3 to 1, a little bit better. And I'm also getting a return that's very, very close to the manifest investing return. I think Mark's at 12.5% right now. And I'm going to do one more thing. Somehow I lost my manifest investing tab right here, so I'm going to go to manifest investing.
Ought to be a law against that.
I know, but I want to show you the chronicle for RAVN because I find it very, very useful to help me with some decision making. So here we go to manifest, and let's call up stocks, and let's type in the ticker RAVN, and the chronicle is right here on the quality sheet. There it is. And what I find interesting, besides the fact that I'm looking at a consistently high-quality company, I really like this quality hovering up near 100% on a very consistent basis. I also, with a par value, and Mark's par, I told you mine is 12.2, he's at 12.7. Mark's par would put this red line somewhere right about up in here where my cursor is right now, and if you take your eye and move back across that graph, you'll notice that's near historical high levels. In other words, this is about the highest par value that we've seen in RAVN in the last, this goes back to 2010, so in the last maybe 3.5, 4 years or more. And I like to buy companies when their pars reach historically high values. This would have been a really nice time to buy RAVN. And I went back and checked my little note card that I keep when I buy and sell stocks. Since 2003, I've owned RAVN 3 times and I've sold RAVN 3 times. And I'm getting ready to consider a purchase again. The last time that I sold RAVN was in December 2011. So right in this period, right in here, I sold RAVN for the final time, and now I'm considering a repurchase. It went off my radar at this period, and that's too bad, but I'll be considering another purchase in here, and I'd like to add to our tracking portfolio, Mark.
Okay, sounds good. Thanks, Ken. Yeah, it's taken a bit of a dip, and it's a decent growth cyclical, so it's not unusual to see that kind of a company take a occasional dip in price. Do you want me to go ahead and switch it back to me then? Okay. And again, you know, longer term outlook is still pretty good for the company, so pretty good stuff. All right, let's go ahead and spend a little bit of time on just kind of the general market. Earlier today, I posted an article.
Mark, before you get started, we have a question from Laureline, and she'd like to know, what is PAR and how do you work it out? Laureline, if you're familiar with the stock selection guide from Better Investing, PAR is the potential average return, and it's just a calculation that would assume that you would sell the stock that you own today. You'd sell it at the average PE value that you set on your stock selection guide, and then you'd calculate the return based on today's price and the selling price at that average PE value. It's the exact PAR that I'm talking about, that Better Investing is talking about, on the bottom of any stock selection guide. Mark, I'm sorry, why don't you pick up where you were then?
Oh, that's all right. I just simply went to the glossary at Manifest, so you can actually pull it up by, take a look at the definition, and then if you click on more, not sure where it'll take us. I think it probably takes us to an article that digs in a little bit deeper. And that might take a little bit of time, so we'll skip that for now. I started to mention there's an article I would urge everybody, the subscribers, if you want a copy of this article, send either Ken or myself an email. But in our general discussion, actually I think I may have attached it to the report for tonight. So let me check that first.
I believe you did.
For those of you that don't know James Montier, I've had a chance to spend some time with him several times over, and he's extremely impressive, a good thinker. Don't always agree with him, but here, along with tonight's meeting notice, there was this article, Equity Markets Are Overvalued. And anytime somebody that I really do deeply respect this guy as an analyst and a big picture thinker, I would urge you to go take a look at this article, because he believes that things are really extremely overvalued. And again, it's just a matter of, you know, getting a good balance of information. So might want to take a look at that. And that kind of sets the table for the three of us to kind of kick around here for a minute. Let's take a look at this chart. I think this one's kind of neat. I added something to this chart for those of you that have been around for a while. This is a chart going back to mid-2002, where we're taking a look at the Wilshire 5000. Now that's the mutual fund, index fund price here that you see on the left-hand y-axis. So the green bars are basically the price of the stock market as measured by the Wilshire 5000. And you can see you know, pretty nice advance here. Here's your Great Recession of 2008, 2009, and then again that recovery that's really bolstered a lot of our portfolios over the last few years, including this fairly recent pretty nice run that we've had. The red is the value line low total return forecast for all 1,700 stocks over time, and basically you see the red running through here. This period in time, we're among the lower return forecasts that we'd seen in quite some time, and we've actually gone through a period where the return forecasts are as low as we have seen in quite a while. And I basically added this blue line, which is just a trend of the green price bars, and that trend has a 7 to 8% rate of appreciation annualized. But the thing I kind of like to do, again, for people who aren't numbers people, this is the long-term trend of the Wilshire 5000, and it actually starts to become kind of obvious when the green bars get ahead of the blue line. Back here at the advent of the Great Recession, you can see they're actually quite a bit ahead right now, March 2014. And obviously the other end of the picture, back in November 2008, March 2009, they'd fallen quite a ways behind the long-term trend. So I just think that's kind of an interesting picture. I think it shows us pretty quickly, you know, how theoretically pricey we might be right now. Any thoughts on this, guys? Or ways to explain it differently, or what do you see when you look at something like this?
Well, the one thing that I would point out, Mark, and I think again, much of it, you need to remember your own risk tolerance on up and down, and as you get closer to needing to start drawing out of your investments, you certainly need to look at becoming more conservative, and certainly as you potentially sell because of overvaluation of companies or because you made a quality mistake in picking a company, sometimes it makes sense to hold cash looking for the buying opportunities. But what jumps out at me at this chart with saying all of that is notice back in December, January, first quarter, I guess December or first quarter of December of 03 or first quarter of 04. I can't quite see exactly which one it is, but right in there. Both you see, as you point out, the breakout where the line goes over trend as far as the market bar, and also the value line is hitting relatively low standards. Notice that's the end of 03, beginning of 04. Look how many years the market continued to go up. In fact, go up more than trend. So you can be in this overvalue, and of course I remember living through that overvaluation, or potentially fully valued, overvalued, saying, you know, this market is looking pretty fairly valued for a long time, and yet it continued going up. So just because you hit lows doesn't mean that the market's going to tank tomorrow. Also remember that we buy companies, not markets. So again, the general upward trend of the market is up, in this case for another 3 years roughly, from when it first started sending a signal, maybe it's fairly valued or overvalued. And if you were continuing to beat the market through that time, then of course you did better than that 30% or so increase that happened over the years. Now, of course, the reverse of everything that I'm saying is that eventually the market did break in late 07 into 08. The market did in fact break, and as you can see, the market as a whole lost around 50% of that value, which actually goes back before the first warning sign. So essentially, had you cashed out completely back at that first warning sign, you could have gotten back in a little bit better, again assuming you timed it absolutely perfectly, but all of that is perfect timing. Kind of a long way of saying, you know, the market, the signals, and it's very much what you pointed out, even with the relative strength index with respect to 3D.
Yeah, earlier. We've got that for the whole market here in a second too.
You've got, you can be showing signs of overvaluation for some period of time, and the market still goes up. So I wouldn't.
Ken, any thoughts on this?
On the other hand, that doesn't hurt building some cash for buying opportunities. Right.
Yeah, Mark, I'm going to come at it from a whole different perspective. I've read so many articles like this and looked at so many graphs like this, and an awful lot of what's being done depends on that blue line. And I know enough mathematics to understand that in order to draw a trend line, you have to make some assumptions and you have to have a beginning point. And I think where you choose that beginning point a lot of times dictates what that line looks like and what the slope of that line is going to be.
Sure.
What would that blue line look like if the trend started on 12.3? rather than on 6/30/2002, but started 6 months later, when those bars were considerably lower. And what if that trend line is started a year before this? I really, I just don't trust somebody picking out a particular segment of time and telling me that this is what's happening, and then expanding that, kind of deducing from the small sample about what's going to, maybe it's induction rather than deduction, but inducing what's going to happen as we move further into the whole thing. I used to work with log tables. Some of the guys in the audience are probably old enough to understand log tables, but it's the difference between interpolating and extrapolating. And I'm wondering sometimes if maybe we're doing a little bit more extrapolation than we should be doing with some of these graphs.
Yeah, I'm with you on that. I mean, it is 12 years, so that makes it different than what many people would be doing. And you're right. Peak to trough is always going to be there. I think what this graph says to me in general, again, if you put our 10-cup model portfolio on here, it would follow it almost. It'd actually be a little bit better, but it'd follow it pretty closely. For a person that's not in that capital preservation mode, being in their 70s or 80s or whatever, again, it's an individual thing. For a young person, they shouldn't be thinking about timing. They should be buying high-quality blue-chip stocks and not being afraid to get a little bit frisky from time to time, but basically staying invested, because look how quickly this, even though we went through, this was the second worst incident in history that you're looking at right here. Okay? And look how rapidly we basically recovered, despite the fact that our economy has not recovered all that well in the last few years. Here's a look at that same information using the value line arithmetic average. Again, look how quickly we recovered from, again, the second worst catastrophe from a stock price standpoint in history. And again, this one also goes to point out, basically theoretically overvalued for quite a long time before the hiccup. And basically pretty much smooth sailing ever since the hiccup to a point where we're overvalued again. So, I mean... Go ahead.
And again, Mark, you see it a little more in the value line chart as opposed to the Wilshire 5000 chart. When you said the quick recovery, it took the broad market, the Wilshire 5000 and the broad market indexes, several years to fully recover and get back to their pre-market levels. You see, it was between 3 and 4 years here. However, I remember anecdotally, the BI community and the manifest community talking about, and as you can see pretty much here with the even the value line, the recovery was much quicker. I believe my portfolio and some that I've talked about, I think maybe Ken's, if I recall, was more like around 12 months, and we were back about where we started.
You're absolutely right, Si. 12 to 14 months, and it had disappeared. Especially because I and some of the people that I invest with had seen a few warning signs and had raised a little bit of cash, which we were then able to really put to work at the bottom of the market.
And I do believe that this is a warning sign worth thinking about when it happens. That's when basically when the momentum falls out of the market. And again, I was talking to an investor yesterday that was frightened about what to do back in 2008, 2009, and I shared this with him. And again, he probably shouldn't be as concerned as he was. Back in this time frame, I mean, he had no idea, because everything that people talk about in the media and in the press is based on this, 40 to 60 drop in stock prices, 40 to 60%. And the fact that we talk so much in terms of returns, it's a whole different perspective if you convert the conversation to, well, what are the return expectations? And you can go back and look at what we wrote back in late 2008, early 2009. For the Kramer fans out there, we were actually saying, back up the truck, back it up now. And that's when the stock prices were down here, even though you had to grit your teeth to do it. And then one of the things I do want to share with the audience is one last thing. And again, I'm going to add these to the agenda to talk about in greater detail for our Saturday morning session that I'm going to hold this coming Saturday. So that'll be on the events menu. But what this is just another indicator that if you look back at the speed bumps and terrible moments in the stock market over the last several decades, this is just simply a comparison of how many new highs versus how many new lows over time. And I added a moving average at 12 months. So again, we're talking about not day trading type stuff. We're talking about long-term perspectives. So again, that really nasty moment back in that started in late 2007 and lasted for the better part of almost 2 years was a time when this moving average dipped down below zero. Contrast that to what we're looking at today. Take a look at how strong this has been. I'm talking about the green area along with the moving average. I don't think we're in a danger zone right now. Of course, that's probably an invitation for disaster. But if people ask me, historically, are you deeply concerned? And my answer is no, not until I see something that looks like this. And by the way, that area back here is the market. And I mean, you had all of this time here before the market actually started dropping. So you had basically 9 months of warning before the market really started, and the market went from here down to here. So I don't know. I look at today's conditions. The other thing that this one reminds me of is every summer there's a speed bump. Okay? Every speed bump. There's your tech sector corrections virtually every summer. So it's weird not to have one. So when people have white knuckles over the tech stocks, keep this in mind come the middle of the summertime. So again, just a different way to look at things. But I say don't do anything different. If you are a more senior person in capital preservation, I think this still suggests to be have a fairly high allocation commitment to stocks. And if you're a young person, forget what we said for the last 20 minutes and go find a good company at a good price. All right, well, thanks, guys. Let's go ahead and press on with Sai's suggestion for tonight. I don't think that's a stranger to anybody. eBay. Take it away, Sai.
All right, thanks a lot, Mark. And I won't talk a whole lot about the company itself, eBay, since I think most of us know the company certainly to some extent as a customer or potential customer, knowing people who are customers of eBay and users of eBay, as well as it's broadly known by the community. You can see here the historical sales and earnings information on the chart, and good consistent sales growth and decent earnings growth, and expected to continue for the next couple of years. Let's go ahead and go to the next chart, and as I usually do on these roundtables, I'll let you know where I came up with the company, eBay. First of all, I was just taking a look at some potential stocks to present tonight. And I went to Manifest. I clicked on the stocks tab, and this is the screen that comes up when you go in to enter a ticker symbol or to look for a company. You see that it's just a sweet spot screen of high quality companies, and eBay happened to be at the very top of that screen. Let's go to the next slide, and I'll show a specific stock search. And I called this the peaking market screen. I suspected we might talk about this sort of thing tonight, but I can read the historical returns chart and the projected returns chart and so forth as well as anyone. And what I like to do when the market is at relative historic highs is I tighten my quality standards somewhat, and you can see the criteria that I used based on my par being down around 5. I just set a par of 10, roughly the 5% over my par goal, to do a minimum. But the two real important criteria that I put in. I ratcheted up quality to 90. So I'm looking at the best of the best, and tightened financial strength even to a high point, which, as Mark's pointing out, A+ is roughly what that works out to. And here is the screen that you what results comes up. And you notice that 4 of the 5 that have better returns than eBay are already in the roundtable portfolio. I was looking for a new company tonight, so I just discarded C.H. Robinson, Cognizant, Infosys, and Apple, and I really am not terribly interested in a metals and mining company, which was Southern Copper. So that just confirmed that eBay fit my criteria for being a very high quality company. I'll take a moment and talk just a little bit about eBay. Said that I wouldn't do that a whole lot. We all know eBay as a buying and selling place. Started out as an auction market for collectibles. If you've not been to eBay or not studied eBay in a few years, you might not realize that the vast majority of business is now fixed price. To redo a phrase that's used in, I think Oldsmobile uses it right now, but you hear it reiterated in a number of different forms. This isn't your father's eBay or your eBay of a couple of years ago. 70% of the marketplace business, which is one of the 3 divisions of eBay. eBay has 3 divisions. Marketplace, which is the buying and selling business. They have payments, which is PayPal, and I'll mention that in just a second. And then there's the enterprise division, which is their newest division, and I'll briefly mention it. But the marketplace division, 70% of all sales in the marketplace are now fixed price sales, and that's increasing every year. So eBay is becoming much more of a fixed price marketplace. Another thing that I'll just mention on that note is that while eBay certainly has a lot of small sellers out there, they also have a good number of large sellers. In fact, I have purchased, a couple of years ago, I purchased a Nook tablet computer, and I actually purchased it from Barnes & Noble through eBay. eBay acts as a marketplace for a lot of companies, and there's quite a few large companies now that are using eBay as their storefront marketplace, sometimes in addition to their own, sometimes exclusively the place to sell, especially when they sell refurbished products or something other than a totally new product. Morningstar calls this strategy that eBay partners with their potential competitors, as opposed to the Amazon model, where Amazon actually sells everything. Now, Amazon also has a marketplace, but by and large, Amazon competes even with its marketplace people. eBay does not compete with its marketplace customers. It partners with them and sells. And they have been trying to boost this fixed price business by a lot of same-day shipping and free shipping offers. So that is the selling side of eBay. The other large division of eBay is the payments business, which is the PayPal business. If you follow the financial press much at all, or if you follow eBay, you know that right now Carl Icahn is trying to force eBay to perhaps spin off or sell the PayPal's business. But PayPal is about 40% of eBay's revenues, and that is was originally purchased by eBay to facilitate their buying and selling, to serve as a payment processor for eBay sales. But PayPal now is accepted by quite a few retailers. I believe 70 or 80 out of the 100 largest online retailers in the United States now accept PayPal payments. So it has gotten much larger than just eBay. And then the newest division, which is a very small portion of revenues right now, is the enterprise division. It was an acquisition in 2011 of GSI Commerce, and that is just the back office support for sellers, warehousing, shipping, and fulfillment services, which again is somewhat similar to what Amazon does for many of their marketplace customers. So eBay is becoming much more of a direct competitor in some ways to Amazon. But looks quite attractive. The company is projecting, well, let's go ahead and go to the next screen. I like doing a quick industry study before finalizing everything here. You could see the specialized consumer services industry. eBay is the best quality and pretty much has the best opportunity. You see Stamps.com, completely different type of company, but in the specialty consumer area, and has about the same par. And then you can also see the profit margins, which are a little bit on, they're certainly steady, maybe a little bit of an upswing. You see a little bit of change back in the late single digits of the 2000, and some of that was PayPal coming on board. PayPal's a lower margin business than the historic auction business that eBay had, and so you had a little bit of an adjustment down of margins, but they've steadied over the last several years. All right, let's go ahead to the next slide and look at the judgments. This is the eagle for eBay, reflecting my judgments, and I project 13% sales growth, which I think is basically in line with the manifest default, a little below, but basically right in line. Value line has about 12% projection, and Morningstar's running a little bit higher. The company is projecting 14 to 16% through the next 2 fiscal years. Net margins, I'm projecting a little bit higher than the last 12 months. You saw it kicking up just a little bit to 18%, and then a PE ratio a bit below the current PE ratio, but around 21, which then gives me a projected annual return of 10.7% for the company. So eBay is my projection. I'm trying to help Ken out and boost our growth rate a little bit. 13% is not going to help a whole lot with just 1,000 investing, but those of you, when you vote in the audience, you can vote for it and double us to 2,000 and help boost our sales growth a little bit more.
Oh, listen to him campaigning, Ken.
He's going to make buttons at the next round table and mail them out, you know.
He'll have buttons for everybody. There you go. Well, thanks. Good stuff. Yeah, and basically what this shows me is that Morningstar and S&P are a little more optimistic than Value Line, who is a little more conservative about the expectations. I think it's fascinating how well they've implemented PayPal into their business and raised those margins. That's just good management.
Yes.
Good stuff. All right, thanks, Cy. And now for the entertainment part of this tonight's session.
Before we get off of Cy,
okay.
We just have one really quick comment from Jean, and Jean is just letting people know that she finds that you can easily and safely send cash through PayPal to any other email address. So it's not just that people are paying bills, but they're also transferring cash, probably between family members or close friends, something like that. And she wants to know, Cy, if you think that will figure into the business going forward.
Well, I think certainly eBay is leveraging the PayPal platform beyond just itself. As I mentioned, they are pushing it very hard for transaction processing for other retailers completely separate from eBay. And in fact, I have not looked at it personally for a while and don't know the status of it, but I know PayPal was working on getting accepted in traditional brick and mortar retailers as well, perhaps through smartphone technology.
I have heard something about that.
So that's kind of a long way of answering. I think, yes, this person-to-person payment processing, that is an area of growth. Some banks are looking at it. Some other credit cards and payment processors are looking at it. I think that is an area to be of potential growth. And PayPal is seeking to grow in more traditional, what you might call credit or debit payment processing areas as well. And I think that eBay has done a good job of extending PayPal, and PayPal is their fastest growing segment, growing in the high teens, and I think that will continue.
Thanks a lot, Si.
Are we good? Good to go?
Yes, Mark.
Okay. Well, that brings us to Body Central, a selection that I made a few months ago that hasn't worked out real well so far. I'm sure that if you wanted to buy something from Body Central and use eBay to do it, they would be happy to sell you anything. They need that. This is not up straight and parallel. You can see that the most recent value line on the company had them in at about $4, and that was a return of 38%. That's the low total return forecast. And tonight they hosted a conference call talking about their 2013 results, and the price dropped from $1.62 to $1.24 after hours. They really put out a very impressive moment. My whole purpose of bringing this company is as a true deep value opportunity. This is not a company I would want to own forever. The apparel companies drive most of us crazy around here. But I do look at a company, this is a different looking stock selection guide for a lot of reasons. The earnings falling off the page are kind of a tribute or an honor to Hugh McManus, who every once in a while will look at those type of companies. But actually what we're looking at is a full long-term cycle for value line. You see the value line assumptions out here for the year ending 2018. This is a business that's been around since the 1970s. And they actually have done pretty well up until this is basically their first really rough patch in the history of the company. But it does appear to be a company that is capable of growing at 6 to 8%. And if they can put the train back on the tracks, yeah, could they basically get the type of margins which would drag these earnings back? I think they could. But just to be clear, size passing out buttons, I'll blow kisses. This is a non-core speculative selection. It's not the type of thing that is for, I'm not even convinced that it's a good time for it in general with the market being so pricey, but I figure since I've already lost 90% of my original $1,000 in it, it might be an interesting time to look at for the reasons I'll cover. One of those reasons is when the headlines start looking like this. And this is actually from Seeking Alpha. I do not know Dallas Salazar. It does mention that he is somehow involved in shorting stocks, so sometimes that's just useful information to know. He's not real optimistic about the company. You can read. It does say the bankruptcy looms, and until, in fact, after this article, or right at the time of the article, they did take on some debt, so I suppose they now are a candidate for bankruptcy, but until that, they didn't have any debt. But again, this type of headline actually kind of draws my attention in full contrarian speculative mode. And again, not the type of company that I want to marry, but is there a potential deep value opportunity here? Just hold your laughter, Ken.
I'll tell you, Mark, this kind of spelling draws my attention as well.
Where's the spelling error? I didn't do it.
Body has passed the point of no return.
Oh, well, that's Dallas. That's on Dallas.
I understand, but it draws my... I mean, you asked me about Project Loon in Google on April 1st,
that does make this one fair game, and there's no doubt about it. Here's an article from a few days ago. He was speculating about, Dallas was speculating about them not being able to find a bank that would return a phone call. but that doesn't appear to be true. They did actually secure a loan and a line of credit to protect their working capital needs. In fact, I did something tonight that I've done, I believe, 3 or 4 times in over 20 years as an investor. I listened to the conference call that they had tonight. I'm sure the transcript will be available. It didn't fill me with overwhelming confidence either, but I don't know, just something about listening to the executive's voice. I mean, I can point to a couple conference calls in the past where I listened and just the tone of their voice made me rush home to sell the stock. I was kind of okay with these guys. There's the boss man right there. This Steph Wissink was the first analyst on the call to ask a question, but they did actually nail down some a cushion, a safety cushion if they do happen to need funds. Just to give some numbers to kick around, they are talking about a fourth quarter loss. Times are tough. The weather has hammered these guys. I know we're not supposed to blame the weather, but I do think that for some of the retailers, the weather in much of the country has been a nightmare. And you can see that their cash on hand has been, just to give some context, in the 16 range back in 2010, and then around 40 the last couple of years. And of course, this last year actually drew that down to about 20, as you see here in the value line data array. Now, they still have about 21 million in cash right now, so they kind of did stop the bleeding. And they actually had fairly favorable words about, I mean, keep in mind they were talking about the end of 2013, but they're only days away from reporting first quarter 2014, and they certainly know what kind of traffic and stuff that's going on. Order conversion in the first quarter of 2014, and I got to say they sounded, I realize it's some of their roles to be cheerleaders, but they sounded not panicked, not thrilled, but not panicked. Again, we're talking about a company that is, until a couple days ago, had no debt. So they had no debt. So again, a hard time going bankrupt until that situation changed a little bit. But again, just looking at the company over time, keep in mind the company's trading at $1.24 tonight, and the book value is somewhere in that $5 range. So they're trading at an 80% discount to book value for those of you that think about deep value opportunities. And again, going back to that original graphic, if they can get back on their feet, and one of the things that the CEO said in response to questions that actually does grab me and rub me the right way was the stuff that you see us doing. They've actually let a couple people go. They've closed a few non-performing stores, but they really are attempting to go back and stabilize using the stuff that has worked in the past, and go back to the stuff that they know has worked. And like I said before, kind of the notion of putting the train back on the tracks. Certainly not a sure thing, but if they're able to do that, these are the type of numbers we're talking about, needing to cover with those cash reserves, and that would certainly do it. So perhaps not in quite as deep as much of the analyst and investing community believes to be the case right now. So again, certainly not a done deal, certainly a turnaround story. And here's a look at the trading history of the company going back. And again, this is going to look dramatically different than the other graphs that we looked at. This company is down 83% over the last trailing 12 months. And they actually went down another 25% today. So pretty nasty stuff going on. This is when the company was added to the round table. I got to confess, I looked real hard at selling this company right here. And I can tell you why. And the why was that it didn't clear the 50 on the relative strength. And basically was at a situation where watching this stuff carefully probably should have run for the hills. But now in hindsight, without 20/20 hindsight, we have a tremendous opportunity down here to $1.24. The other thing I noticed is that for the first time ever, the company has a relative strength index below 30. So maybe this is the undervalued opportunity that could make some sense. And again, could be the type of thing that has a decent, fairly short-term return, and we can exit the position. And this is my inspiration, my Southern Comfort, as I have said with Cy a few times, my Select Comfort, I should say. I mean, this situation does remind myself, it reminds me of Select Comfort back at the advent of the Great Recession. And it actually dropped all the way down to 19 cents a share. And I had buddies that called me and said, you know what, this company doesn't have any debt, B plus financial strength. Unless you think the last mattress has been sold, Mark, this could be an interesting speculation. And again, the stock price hit 35.60, guys. It's all the way back down to 16. Even at 16, this is true. That's per year, annualized. So, I mean, these type of opportunities for those that can speculate, remember what I said? Non-core, speculative opportunity, and the lips were there. this is one. And there's one other really important thing to talk about here. If we go back to number of stores, I mean, they're not going to increase their number of stores. I don't think this number is, I think that's absolute science fiction. They've curtailed this quite a bit, okay? And what Select Comfort shows me here is even in the situation where a retailer cuts back on their number of store count, see here how it actually flattened out, you still can have a return of value situation to investors. So that's my inspiration. It's a long shot. It's a speculation, and those lips are there for a reason. It's either going to be a welcome kiss and a hug or a blown kiss goodbye, I guess. So we'll come back to this one after we do the audience poll. But again, Hugh sends his best regards, and bottom line is there's not a whole lot of companies that are grabbing his attention these days. We'll come back and look at it for that part. Ken, are you ready to do the selection?
I'm absolutely ready to launch the poll. I hope we don't have very many speculators in the office.
Hey, don't go stacking the results.
I should lobby for eBay right now, you know. Here we go, folks.
It's
We're
unfair.
launching the poll. The poll is open.
How many votes do I get?
All you have to do is use your mouse and click one of the stocks. If you don't think any of them should go into the portfolio, click none of the above, and we'll see how the results poll out. I'd like to see at least 80% of you voting. We have a nice audience out there again this evening. So let's get that percentage voted up to 80. There, it's gone above 80. Can we hit 90? Just click on a stock and tell us which one you'd like to add to the portfolio.
Am I winning?
Yes, you are.
So, and we've almost pushed it to 90%. So I'm going to count it down in my mind here. We're going to give you 3 more seconds to vote if you haven't already. And let's close the poll. And let's share the results with the audience right there.
And Mark is the winner.
eBay pulls it out on top of RAVN, 45 to 38%. None of the above has 14%, and Mark, 3% of the people listened to what you had to say and are gonna lie on that mattress right with you. Okay.
I just want you all to treasure and cherish this moment when I'm accepting the trophy and the statue at next year's annual awards ceremony. We're gonna come back to this moment. I'm warning you.
Okay, I'm hiding the results, and you can move on with your slides now, Mark.
All right, we'll go back to the quick look at Hugh here for a minute. And then we'll come back and tell you about some of the events in the area. Again, Hugh apologizes not being able to join us tonight. He had to head back to New York. This is just a quick value line I put, looking for the types of companies that Hugh might be interested in. It's sorted from highest to lowest return forecast. And again, his whole thought process is to find a high-quality company, hopefully with fairly high financial strength, perhaps very little debt. And you can see that these return forecasts actually drop pretty quickly going down the chart. And very few of these companies are companies that he is really warm and fuzzy about. You know, if he's running checks on the 52-week price, I know he's not real wild about the retailers like a Body Central, for example. Notice how many of the retailers show up on here, by the way. from Guest to Urban to American Eagle. But notice that his Staples does show up, and he probably would be watching that one carefully as one of his more non-core selections. But again, not a whole lot of robust opportunity. Been a few companies on that list that we've added lately, but notice that Apple is on here.
I'd love Mark to set up orange cones and big caution symbols around number 10 on this list here, Mindray Medical. If you're interested in this particular Chinese company, I would urge you to do a lot of reading. There's a lot of current information out there right now that might just scare you completely away from anything to do with Mindray Medical. So orange cones, caution signs, everything around that particular company.
Okay, I'll bring that one next month to see how many votes we can get.
Okay, great.
All right, well, let's kind of close down some reminders with some of the events and opportunities that are coming up. Ken and I will both be at the StockFest 2014, April 12th in Grand Blanc. Many of you that are listening here tonight are definitely within driving distance of that. And that's a half-day program, correct, Ken?
It starts at 9 in the morning, goes to 2 in the afternoon, Mark, and includes a nice lunch.
So it's a little more of a full-day program, so that should be a good time. It's sold out. In fact, I think Ken's looking for a bigger room for that event. So that's some good clean fun. We'll be with our friend Herb Lemcool up in Traverse City on May 3rd. Ken and I will both be up for that. And again, that's more just of a roll the sleeves up and have some fun talking about long-term successful investing. Same theme on May 10th in Auburn Hills, although this one will have a little bit more of a beginning and retirement plan focus in Auburn Hills for those of you that are interested. The information on that event is already up on the Manifest Investing website. And then Ken and I will both be in Chicago, as will Hugh, for the Better Investing National Convention May 15th through the 18th.
And in fact, Mark, we're going to make an attempt to run a Mid-Michigan Roundtable live from the Better Investing National Convention. We're going to broadcast it to our audience, so if you can't make it to convention, we'll bring convention excitement right to you with a live Mid-Michigan Roundtable. We'll announce the exact time and the date when it gets closer.
And we'll be highlighting the tremendous return achieved on Body Central as part of that program.
Yes, we will.
All right, so with that, I think we'll go ahead. We'll stick around for questions and answers, but again, I'd like to thank Ken and Cy for their participation in tonight's event, and we'll come back at you about a month from now. Ken, do you have the date handy for next month's program?
I sure do. If you give me just one moment here,
okay.
Mark, our next roundtable will be on April 29th.
Okay, April 29th. So with that, we'll say an official good night, and God bless all of you. Thanks for attending, and we'll look forward to seeing you again. And we'll stay on for a few minutes here.
Thank you, everybody. Special thanks to Cy. Special thanks to Mark. As always, Mid-Michigan appreciates you guys more than you ever know.